know this. When the Federal Reserve meets to talk policy, it's not usually something that grabs headline news. But that's not the case right now. Today, Fed officials met in Washington, D.C. for one of their most anticipated gatherings in years. At stake is a seemingly very simple question. Will the Fed finally raise interest rates? But as simple as it sounds, that question is actually a very complicated question with serious implications for the economy overall. Just a few months ago, when the stock market was reaching record highs, the Fed looked poised to raise rates after keeping them near zero for almost 7 years. Doing so, those in favor of raising rates said that it would help keep inflation under control and put the Fed back on a more normal footing after years of being locked in crisis mode. But now, with the Chinese economy sputtering and the American economy not close to meeting its inflation targets, many economists argue that raising rates is unnecessary, or even worse, dangerous. Head World Bank economist Kaushik Basu, for example, told the Financial Times recently that such a decision could yield a shock and a new crisis in emerging markets, especially as it would come on the back of concerns over the health of the Chinese economy that have grown since Beijing's move last month to devalue its currency. And former Treasury Secretary Larry Summers said pretty much the same thing in a Tuesday piece for the Washington Post, writing that monetary policy should seek to avoid major surprises. A move now, given how expectations have been managed, would be an extraordinary shock at a highly uncertain time. That shock could come as soon as 2 o'clock tomorrow afternoon, when Federal Reserve Chair Janet Yellen is scheduled to hold a press conference right here in Washington, D.C. So, will the Fed raise rates? And if it does, or even if it doesn't, what does that mean for our economy going forward? Let's ask Marshall Auerback, a research fellow at the Levy Institute and director of Economists for Peace and Security. Marshall, welcome back.
Thom, nice to be back with you.
It's great to have you. First of all, give us some background. Why have interest rates been so low for the past several years? I believe this is historic. Correct me if I'm wrong. What has the Fed been trying to do with this?
Well, it has been historic, and it's a very good question because there are a lot of different theories as to why they've kept it low. I mean, there is one argument that because you've got such a heavily indebted economy, a large amount of private sector debt, that the Fed kept rates low in order to reduce burdens off borrowers. But of course, borrowers and lenders both need to be healthy for there to be any kind of robust lending activity, and that's really the job of fiscal policy. And but I think more to the point, I mean, the low interest rates, it was an experiment. The Fed, I think, was trying to reestablish the status quo ante. In other words, they were driving rates sufficiently low so as to incite or re-incite speculation, to incite moves back into risk assets, and in fact to start up a bubble all over again. And in that regard, they've succeeded, though I don't think Main Street has particularly prospered from the policy. Is there any
let me lay out an analogy sort of scenario, and you tell me if it makes sense or if it's crazy. Back in 1929, when the stock market crashed, rather famously, the Fed under Herbert Hoover did nothing. I mean, there was very little, as I recall. There was virtually no response to that, and it really took this enormous stimulus, first of the New Deal and then secondly of World War II, which was a giant government stimulus program, to put America back to work. In 2007, when housing started to fail, just like they had in 1927, before the crash of '29, in 2007, when housing started to fail, and then in 2008, when the crash happened, the Fed did something very different. They dropped interest rates like crazy. They'd been low already to begin with, and they poured literally trillions of dollars loaned out to all kinds of groups, which had not been done in the 20s. If the Fed in the 20s, in 1929, had done what the Fed has done now, would we have avoided the Great Depression? Or let me flip that around. Has the Fed since 2008 simply been holding off the inevitable, that something has to rebalance? I mean, there's all this discussion about how stock prices are much, much higher than their underlying value, for example, because of interest rates being so low.
Well, yeah, I mean, look, it helped a lot that they lowered interest rates and didn't tighten monetary policy, but I think way more important was the fact that, at least for the first year in the aftermath of the crisis, all governments around the world engaged in massive stimulative fiscal policies, which of course was very, very different from the 1930s. The characteristics leading up to the great financial recession of 2008 were very similar to the 1920s. We had a huge speculative boom, we had an overly financialized economy, and we also had a tremendous increase in private sector debt. The difference, there's two key differences. One is that in the case of the U.S., fiscal policy remained very, very aggressive for a number of years. Ironically, in fact, when Roosevelt began to try to balance the budget in 1937, the economy had a relapse again. So, in fact, it highlights the importance of fiscal over monetary policy. But the other important thing that happened, and this is where I think we have a huge difference today, is that the authorities, both the political and regulatory authorities, downsized finance substantially. I mean, we had the Pecora Commission, we jailed a lot of bankers, and we shrunk finance as a percentage of GDP down to, to where it was virtually nothing. And you also introduced Glass-Steagall, and you introduced a lot of financial regulation, which effectively kept finance in its box for many decades, and you had an unparalleled amount of prosperity in the post-war period as a result. And it's ironically, the very success of those policies led to some complacency, and gradually that regulation was torn apart a lot. It started under Reagan, but it continued very aggressively under Clinton and Bush. And this time around, we have Dodd-Frank, which I think has made a marginal difference, but certainly we've done nothing to rein in finance, and if anything, it's larger today as a percentage of GDP than it was in 2008. Certainly the largest banks, the 4 or 5 largest banks in the country, have more than 50% of all deposits. The community banks, the smaller deposit-taking banks have been screwed in this kind of environment, and we've effectively restored the status quo ante. What the Fed has done is effectively incited speculation, as I said before, and they're hoisted on their own petard because they've been so successful at inciting speculation that they're worried that if they start raising rates, that's going to come to an end.
And it sounds like, in a way, what you said in response to my question was that I was not actually just describing Fed or monetary policy. We were talking fiscal policy, legislative policy,
yeah, that's right.
Stimulus,
that's right.
spending money, and
yeah,
similarly
in fact,
with the Obama
I would say
stimulus.
Yeah, and I would actually say that's what
this.
actually. Well, I've always thought that monetary policy is overrated. In fact, if you look back in 2009, 2010, we had a fiscal stimulus, a fiscal deficit equivalent to about 10% of GDP. It was a very, very significant number. And of course, the Republicans and indeed some Democrats said this is absolutely crazy. This is going to destroy the economy. We're going to have hyperinflation. But in fact, that was actually what put a floor on demand. You had the automatic stabilizers come into effect, which you didn't have in the 1930s. You have Social Security, Medicare, and a large amount of government spending at historically unprecedented levels, except for war. And that, I think, is what helped to turn the economy around again. But I think, ironically, fiscal policy is too tight right now, and so people are resorting back to private sector debt growth again, and I think that's very, very dangerous.
Yeah, and fiscal policy being too tight. In other words, we're still in austerity, we're still in sequester, we're still in this madness. So what should the Fed do, and how consequential might it be or not be if they raise or fail to raise or don't raise, choose not to raise interest rates, even
I think even if they raise them, they might raise them, a quarter of a basis point or 50 basis points in total. I don't think they're going to do much, but I do think that the most important thing that the Fed can do, especially if we're talking about the external environment, is we now have these things in place, the dollar swap lines, the dollar swap facilities, which we introduced in 2009 because there was a shortage of dollar liquidity and there was a lot of dollar-denominated debt out there. And when the Fed began to open up dollar swap lines with other central banks, that helped to stabilize the external economy. And I think that the Fed will have to make available dollar liquidity to the rest of the world, which they can do through the swap lines. That would be the best way of ensuring that you don't have more of an emerging market meltdown.
International version of QE?
Well, not really. I mean, because of course the central bank counterpart is guaranteed to repay the Fed at a fixed exchange rate. But it does mean that what it means. Look, the situation you had in 2009 was that you had a huge surge in the dollar because all these private sector banks had a huge amount of dollar debt. Wall Street had managed to export all these collateralized debt obligations to these foreign banks, and they were desperate to find dollars to offset the collapse in these loans. And until the Fed actually introduced these dollar swap facilities, these currencies were weakening very, very substantially. As one, my friend Barclay Rosser put it, he said, look, the Swiss franc, had they not had the dollar swap lines, it wouldn't have been worth the value of toilet paper that you scrape off your shoes in Grand Central Station. So I think that was the most important measure that the Federal Reserve took as far as the international environment went. Quantitative easing, I think, was just a gift to speculators and did nothing really for international stability or indeed for Main Street as far as the economy went.
Right. In the 15 seconds we have left, do you think that the American economy right now is fundamentally strong or fundamentally very shaky?
I think it's still fundamentally shaky. I think finance is way too big. We still have a pool of underutilized labor. We have people taking jobs under what they normally would because they can't find anything else. And you still have very, very high prevailing private debt levels. And that's a real problem going forward.
Marshall Auerback, thanks so much for being with us. It's always great talking with you.